Welcome to It's the Economy. We've spoken about the food inflation shocker, which is hurting banks and rate sensitives right now. But also on Monday, we got the July import-export data. And we saw goods exports declining a bit and services exports stagnating. In this context, Neelkanth Mishra, the chief economist of Axis Bank and head of global research at Axis CAP, has written an interesting note arguing that services exports may decline now in the near term, but in the medium term, they will be strong and take away our current account and other macro worries. But how do stock investors play all these macro data? Neelkanth is my guest today. So let's ask him all those questions. Good morning, Neelkanth. Thank you very much for being with us. Well, I did invite you for your current account and BOP report, but this inflation number is a bit of a shocker. What are you expecting in terms of macro changes, and what is the advice to stock investors?
You know, tomatoes are a very short cycle crop. I don't know how relevant my own experience is, but when I bought tomatoes yesterday, they were at about 100 rupees a kilo versus what 170 when I last bought them about a week back. So clearly that's correcting. There was a viral infection and we all discussed it enough. The most important takeaway for me from the inflation report was that the core inflation number was actually better. And I think that's what we need to focus on. This expectation many had that interest rates will start falling early next calendar year, I think that was totally misplaced. And thankfully, that expectation is now getting corrected. The fear that this will necessitate another round of rate hikes is something that I, again, don't buy into. We have to remember that MPC is now targeting 4% inflation at the midpoint, so it is 4 plus minus 2. There was a belief that the moment inflation goes below 4, the RBI will start cutting, MPC will start cutting. I think that was an irrational expectation to start with. And therefore, I think rates will stay on hold at the repo level for quite a while.
No, actually, cereal inflation is the one that perhaps some people are worrying about, which might give food inflation a bit of staying power. There is a worry that perhaps the rice crop will not be as good as we thought, excess in some place. And the fear that, therefore, RBI already imposed a CRR, an incremental CRR. Out of sheer caution, will they continue? Basically, I'm asking you if the cost of capital, therefore, increases, would finance stocks, NBFCs, realty have something to worry?
See, the longer rates stay on hold, the higher the effective rates are, right? So the weighted average lending rate on incremental loans are higher than the weighted average lending rate on outstanding loans. So if repo rate stays unchanged for another year, there will be effective tightening. And I think that's the reality that we should all be aware of. The fact that cereal inflation or milk inflation, and there are other things that, but I think the MPC is very clear that there is a quantitative element to it, there is a price element to it, and some of the CRR hikes that we have seen, or rather the incremental CRR, was more or less on the excess liquidity that came into the system because of the currency notes coming back, which was quite a bit higher than what anyone had expected. So those are, I think, more tactical. If we are thinking out over 12 months, I think financials would still do pretty well.
Okay, fine. Now, let me come to the very interesting report you have written on services exports. You do accept that there can be a near-term problem for services exports, but we have stagnated. This 27 billion of monthly exports is just refusing to improve. We did 32 in January and December, but thereafter we have remained in this figure. Do you think this was just a one-time thing because of COVID or middle office moving a bit, or are you still confident we can harvest a lot of jobs, with jobs moving to India?
No, I think we can, and it's useful to put this 0% or 3% growth year on year in context, because it came on the back of 40% year on year growth. And if you split up the services exports numbers, not just from India but globally, a very large percentage is travel and transport. The transport segment, which is linked to goods export, right? So it includes things like freight, includes things like insurance. These are doing badly because, as we have seen, goods exports globally are slowing down, and freight rates have fallen back to pre-COVID levels after going up 5x. So that's a cyclical adjustment which will show up in the numbers, in the headline numbers. Then there are modern services, which is what we are most excited about. So these are the non-IT services, business services exports, basically consulting jobs being done out of India, or parts of consulting jobs being done out of India, semiconductor fabs being run out of India, procurement for large US retailers being now done out of India. There are a whole range of services which are now shifting back to India. Engineering services, very, very large move. Now, these exports are growing structurally, globally as well. And India is over-indexed on them. So almost 3/4 of our total exports are of this category. And there are structural factors which are driving this. This change, we flag in our report, started not in 2020, but in 2017. This is when the immigration controls started to show up. This is around the time when cross-border internet bandwidth started to grow at 40% year on year. This is around the time that demographic pressures started showing up in a big way in China. And a lot of the business and trust actually started to build with India. So there are many structural factors we highlight in our report. There are two cyclical elements, which of course are negative right now, which are wage growth in the US and the number of job openings. So, India's growth in services, or this growth in India's services exports, is as much about skill arbitrage now as it used to be about cost arbitrage. But still, cost arbitrage is important. So if US wage growth was very strong, there was an acceleration in India's exports. And on the IT services side, we are seeing that, right? So those numbers, which were in the mid-teens, have now slowed down to single digits, and some of them even maybe seeing a decline. But the conference that NASSCOM had on GCCs in early June was remarkably well attended. In fact, my colleagues in their report have put pictures of that conference. It was overbooked even in early June. And we are starting to see some very good traction on the commercial real estate side and in science, despite the fact that there is an impending recession in the US. There is an improvement in the kind of visibility that we see. So I think over a 2-3 year period, as you rightly said, this can actually wipe out a current account deficit, and we believe can create 2 million high quality jobs. And if you include things like inbound travel, maybe 3 million jobs over the next 3 years.
Okay. No, got that. We have, at CNBC, we have trumpeted this over the past 6 months. I mean, it's not just engineering and consulting and all that you speak. We've heard even of audit, tax, compliance, just middle office moving to India. I take your point on all that. Now, how do we play it at stocks? How do we play it as... Yeah. Sorry, go ahead.
Space and, very high-end technology is now $2.5 billion a year. So there's a whole range of services we're providing.
Services that's coming. Yeah, how do we play it? Because you are actually warning against buying IT. Tell us also what we should buy. Yes.
Yeah, so let's see the positive side first. So the positive side, I think the most obvious ones are the REITs, the real estate investment trusts. And we have to remember that during COVID, as work from home picked up, so if you had 100 or space for 100 people and you had 120 employees, right? So there are some BPOs, for example, which do rostering, so you can have multiple shifts, people sitting at the same desk. During COVID, because work from home, this 100 went to maybe 40 or 50. And over the last 3 years, even as it has grown, this has moved up only to 80, 90, and this 120, the number of people employed has gone up to 150. Now, we are now starting to hit a point where I think the incremental leasing will start to go above what was pre-COVID levels, and we think that would be beneficial to REIT stocks. We also think that this is very important for premium consumption. So just like 2-3 years back, people were in disbelief that the SIPs will not sustain. I think there is a sense of disbelief that some of the premium and consumption that we are seeing is not likely to sustain. But if the job creation there are some consulting firms where average billing rate is above $50,000. Which means that the average salaries that are being paid, remember that this is going to be based on a cost plus scenario, the average salaries here would be upwards of 15-20 lakhs. So there are a very large number of jobs being created, and therefore the segments which deal with premium consumption, whether it is larger cars, I mean, if you see the share of by value of cars in the PV market has fallen from 70% in 2012 to 30% now. So the manufacturers, so those are again segments. So once you go down the premium segment, there are lots of interesting things that you can play with.
Fair point. So premium consumption, consumer durables, especially the premium end is what we should be looking at. REITs as well. And IT stocks probably because of the competition. But I want to bring in one more point. As you speak about IT, for want of time, we are banning laptops and etc. being imported. Are we likely to shoot ourselves in the leg about this entire service exports theme?
I don't think there is that tight a relationship between near-term restriction or I would say sand in the wheels on laptop exports, which at least from what I read from the press is to encourage the IT hardware PLI scheme to pick up. And it is less about just putting import controls. I think the side effects of some of these schemes have to be thought through. But I don't see that as, it may be a near-term hiccup, but some of the trends that are driving the surge in business exports out of India, non-IT business exports out of India, are so structural that they could be as transformative to us, to our economy, and our external accounts as the IT services have been over the last 30 years. On IT services themselves, just half a minute on that.
Yes.
Our concern is, one, that IT services demand numbers will continue to disappoint. This is something that I've been concerned about for the last year and a half, and I still remain concerned, and I think there's still downside to those. The second is that most of these firms which are starting off or are starting to come to India for the first time want trained manpower, and therefore they're likely to poach from the IT services firms. And so there is going to be quite a bit more of competition from the margin side. And remember that some of the software as a service firms are also still growing very well, and that is also good for India, but may not be that good for the IT services firms.
Okay. Point taken. Thank you very much, Neelkanth, for a very interesting report and a unique way of, new way of looking at how we should take advantage from a stock market viewpoint on our services exports. Markets actually have now recovered and almost breaking into the green, the Sensex. So on that positive note, wrap up on Bazaar, Chartbusters up next.